Welcome to another episode of Family Capital Reimagined, a PwC Leadership Insight series exploring how Indian business families are evolving beyond managing wealth and operating businesses to intentionally maximizing their family capital. A comprehensive ecosystem spanning family business, family office, foundation, and non-core ventures that together forge a lasting legacy. Today, we are honored to speak with Anirudh A Damani, a trailblazer in India's early stage investing landscape and a fourth generation entrepreneur from the Damani family. As managing partner of Artha India Venture Fund, India's first early stage micro VC fund, Anirudh blends the heritage of multi-sectoral Damani family active in energy, hospitality and real estate with a bold vision to nurture disruptive startups nationwide. Anirudh is also the founder of Artha India Ventures, the family office that has pioneered early stage investing for Indian families far ahead of the current trend. With investments in more than 135 startups, including marquee names like Oyo, Purple, Rapido, Getwork, Agnikul, Anirudh has been an early identifier of promising entrepreneurs and a key mentor shaping the Indian startup ecosystem. Welcome, Anirudh. It's a pleasure to have you here today, and thank you so much for being with us.
Thank you so much, Vivek. Truly enjoyed, getting here and looking forward to our conversation.
Absolutely. So I'll dive straight in, Anirudh. I mean, looking back at the inception of Artha India Ventures, which has been immensely successful, what was that defining moment that came to your mind to, start looking at things very differently? Putting your family wealth in some sense beyond traditional asset classes. Which was not done at that point in time.
Yeah.
So it'd be great to hear your journey.
I think to say there was one defining moment would probably be too simplistic, right? Hopefully there was one like a Bollywood movie. There was that moment that changed things, but it wasn't. I think there was a series of things that happened, which when you look back, you can start connecting the dots and say, oh, you know what, this now makes sense. But when you're living through it, it wasn't the same thing. So one of the main things for me was coming back from the US after my business in the US was sold, and then coming to India and then experiencing the Indian entrepreneurship in 2012, which is nothing like what we see in 2026. It's not even comparable. And having to set up a company, then going through the entire pain of setting up a company in 2012, and in that process also dealing with the bureaucracy, dealing with even the pain of opening a bank account back then, it used to be immense. Forget personal bank account, whether it is your corporate bank account, it wasn't very easy. And that sort of pushed me into just starting to invest into startups with more of an idea of, this is maybe a creative release for me, but also at the same time, it was for me to understand the Indian entrepreneurial mindset or entrepreneurial ecosystem better. Because that time, entrepreneur was nothing, right? When you said you were an entrepreneur, you were probably a failed engineer, right? Or you were somebody who could not get yourself a job, and hence you bought yourself a job as an entrepreneur. But if you go back and think that people would not get married if you're an entrepreneur back then, right? Today, obviously, you can get married at Series A also. But it was a very different ecosystem. And I got a chance, again, just Googled, because I was part of this thing called the Dallas Angel Network. So I Googled Mumbai Angel Network or Bombay Angel Network, and found this thing where in Mayfair banquets, this group of people meet every 6 Saturdays or something, and they talk about deals. I said, okay, great, this is the way to understand. And I think going there and seeing those 50-60 angels who talk to the entrepreneur is very different than what we see today. It was actually the reverse of Shark Tank. Like the founder would come on stage, they present their idea. The investors had a chance to ask questions, and then people would put their preferences on a little notepad, and then Mumbai Angels team would then call you the next day to IMC, Churchgate, and there would be a smaller group of interested angels now talking to the founder directly. And that was an immensely, eye-opening experience, because the kind of questions being asked, you had a Sasha Mirchandani in the room, you had Prashant Choksi in the room, you had all these the people that you now associate with Indian venture, all of them were there in that room, and the experience of that really was the turning point. If you could tell me, like, this was that where I started realizing that maybe while I want to be an entrepreneur, India's got this immense amount of, potential, immense amount of energy, entrepreneurial talent that wants to explode. But unfortunately, we don't have entrepreneurial models in 2012 that are from India that they can emulate. Because before that, the only entrepreneurial ideas you could think about were probably Tata's. But Tata is not really entrepreneur. That's a conglomerate. They are massive. But then the only books you would get in 2012, Vivek, that you could read about entrepreneurship all came from the West, and they made zero sense in India. And I'm living example, because when I came back from the US and I thought, if the US is so आपने US के अंदर एक company बना ली, बेच दी, all that happened, then India should be easy. India is completely different, right? India teaches you entrepreneurship starting from the E again, right? Like and I think that's, to me, then realizing that, okay, maybe I have this I was given the opportunity to learn how to sell in the US. I understand the nuances of the US ecosystem. I'm now understanding the one for the US. I can be a bridge, and I can really help entrepreneurs who are great at probably product or service. I can help them sell. I think all of these things combined led to me changing tact from becoming an energy entrepreneur or an entrepreneur in the energy space in 12 and 13 to now saying, you know what, I think my talents could be better utilized in helping entrepreneurs get from 0 to 1 and helping them put together structures for scale in the future. So, like I said, unfortunately, I couldn't give you a simple answer. I woke up one day and there was this amazing background noise that came out and I had this amazing epiphany. Aisa kuch nahi hua. But it was just a series of things that happened which made me realize that maybe I was back in India for a reason, and that my talents could be better utilized in a different space just because of the exposure I had in the US.
Well, thank you for that, and I'm glad that there wasn't just one answer, and there was enough context to it, and then clearly what you've done with Artha has, I would say, defined many things over the last few years. So congratulations on that. But let me also ask you. I mean, obviously you started back then, and you also described what the ecosystem looked like at that point in time. But then you're probably one of the first again who actually then went into Artha India Ventures.
Yeah.
Where you actually started, in some sense, replicating what you did with your own family capital or family wealth, and brought in family offices, etc. How did that come about? What was the need? And more importantly, did that then start driving some change in your investment philosophy, risk appetite, governance?
Actually, Artha Venture Fund, I think you were talking about, right? So yeah, I think initial first 6-7 years, my intent was, we'll make the family office was set up by saying, we'll invest in renewables. The money that comes out of it goes into, the high risk, high reward equity side of investing, alternative equities. And then if we have an exit, we go back and buy some more alternative operating income solutions and just keep these two things moving. But as it happens, I think in any typical Marwadi Indian family, that once you've seen an exit like Oyo and you've seen another exit like Karza, then the family thinks, we have an opportunity to make money. Why shouldn't we all invest in it?
Yeah.
So 2019 really was a year where I was thinking of setting up a fund for our family. 17-18 May, we had decided to move ahead. And while creating that fund, I was already working with some marquee family offices, DSP and others. And at that time, I just felt that if there was a structure with which I could tell a founder that don't worry about going to 10 different angel investors every time we have to raise a follow-on round. And maybe it's some context to that is that, there's also context to this that in the US, typically angel investors can invest up to Series A. India was a very different ecosystem where most angel investors would write one round and that was it. After that, you need to go find your own lead, right? And that typically was not how the US worked. US typically from seed to Series A, the angel investors are putting in multiple rounds of capital, between 2 to 3 rounds, maybe 4 rounds, until you get to a Series A, and then they would also invest more at Series A. So I learned that from watching the US market. So I felt if there was a dedicated fund that I had, where I could give confidence to the founder that, listen, stop trying to find a new suitor for every round. I'll back you all the way up to Series A as long as the metrics are right. And as long as we're working closely and I have confidence, I'm willing to double down in every round with you. So that's where I think the concept of a fund was required, because you could not do that as a typical angel network, because your angel have the ability to say no, right? But then the founder gets stuck because you might say no because of personal economic circumstances. The market tanked 2,000 points. I can't, I'm scared. I don't want to invest. But that founder has built a company that needs that cash today, right? And if that doesn't take off from the runway, it's going to lead to problems. So I think that's where the idea of setting up a fund came together. It was really from a family perspective and having committed capital to to give the founder a strong sense of confidence that don't worry, you don't have to find a new suitor. At least till Series A, I'll keep doubling down. I'll be there. पर हुआ ये कि while doing that, family offices said, hey, you know what, we think this is a great structure. And thankfully, about 60 of them agreed for Fund 1 to put money, and we built India's first early stage micro VC fund.
No, I mean, it's been an amazing story. And I mean, if I just to quote statistics, I mean, with more than 2,300 crores of AUM or assets under management and over 150 family offices. So clearly, I think in some sense, it was an opportunity, and I mean it in a very positive way to help an ecosystem come together. What's your views in terms of how has the outlook of family offices really changed? I mean, between you said 2012 to when you started your first fund, and now with so much success with assets.
I think we're going through a maturity phase now, right? I think so. A lot of family offices, and I'm sure Vivek, you have these numbers better than I do, but roughly about $700 billion worth of secondary transactions have taken place where family businesses have sold out and they have liquidity in their hands. That's why you've seen this splurge of family offices coming together over the last maybe 7 to 10 years, effectively. But when these family offices first got the money in their hand, they all thought of investing entrepreneurially. I can do it myself. Why should I pay somebody else? Right. So you notice that there was a splurge of investing in 16, 17, 18. Then there was a slowdown. And then 19, 20 happened, sort of COVID happened. And then after COVID, every family office was there, venture to karna hi hai. So they felt that maybe institutional is not the way to go. Spray and pray is the way to go. After a 2 year party, we've had a 2 year massive hangover now. But what we are seeing now, Vivek, is that family offices have realized, at least the ones that are now thinking of venture, as saying, this is a part of my portfolio, and this cannot just be fungible play money. If I have to make money in venture, I need to have a dedicated, focused strategy towards venture. So they rather would choose a venture manager who they can align with, and they would rather evaluate the venture manager than trying to evaluate founders directly, because that requires you to have an immense amount of time. You have to go through at least 2,000-3,000 deals in a year to pick 10. Now, how many family offices can truly do that while operating other things in life? Unless you've got somebody dedicating their life for the next 10 years, I will see 30,000 ventures, 30,000 pitches, and I will build a portfolio of only 100 companies out of that. If they can't dedicate themselves like that, I think the family offices are realizing that maybe it's better to go. Let me interview a venture manager. If you're a good guy, I like what you're doing, I'll give you a first check, but then I'll come back with a bigger check in your second fund and an even bigger check in your third fund, as long as you're doing what you promise. I think we're going through that maturity phase. US must have taken 40, 50 years to get through that. I think India has done that fairly shortly. In 10 years, we've realized, okay, ye main nahi kar sakta, so I have to find somebody who does it for me. So we're in that phase today, and therefore you're seeing a lot of the funds are now getting a lot more money. We've had our record fundraising year last year, but it's become easier because now the questions have changed. The questions are no longer about, hey, how much do you charge? They're like, what's your strategy? Tell me how you choose companies. Tell me who on your IC is independent. Can your IC say no to stuff? How many times your IC said no to something? I think the questions have changed. So it tells you that their thought process about venture has changed dramatically.
No, I think that's a great example of actually putting out how they're actually interacting differently, and it's an opportunity and a need, I would say, which you are actually filling in. But you spoke about some of the questions that they're asking in terms of who's on the IC, where do you say no, etc. How is their openness on like newer sectors, newer areas? Because obviously you scout opportunities across the spectrum. So are there areas where they are more amenable to or have concerns with?
I think we become much more comfortable with deep tech of late, right? And I think we should thank the ecosystem set up by the government quite a bit for that, because 10 years ago, if somebody told me that you want to invest in deep tech, and I probably publicly said it also, that I would not invest in deep tech 10 years ago, right? And that it was because the ecosystem was, there were a lot of lab projects, no real thought about how commercialization is going to happen. And so it's very difficult to back something to say, can I wait 10 years to even figure out कि commercially viable है कि नहीं? But now, because the government has created, these there's the RDI, RDIF, there is defense programs, all of which now want to buy. And so the government is not only willing to provide you grant money and they provide you infrastructure, they're willing to be the first customer in many cases. That is now creating the circle of an ecosystem. And I think now family offices are getting much more excited and aligned of investing into deep tech and stuff like that. What I think family offices are no longer interested in, and I think, and thankfully so, in many ways, is that those operating loss companies, right, where there's no gross profit, there's a gross loss, but there is some voodoo math to make it a net profit, right? That part they realize कि ये possible नहीं है. You cannot have, and we are sitting in PwC's office, so I can guarantee you that every person here can tell you that a gross loss company cannot make a net profit. It's mathematically not possible. But I think family offices are growing up to the fact that India is a very high opportunity cost market when it comes to equity investing, and therefore they're not willing to just distribute money in the name of growth karna hai. They're saying, listen, show me a ROE that is higher than my ROI, and then I'll be able to invest in your company. And that's some very smart thinking when family offices ask those kind of questions.
Absolutely. You're absolutely right. Let me try and pivot this slightly to a different lens. Of course, on the same topic, you emphasize a lot on startups who are actually serving Bharat, and that of course is, as a proud Indian, a great thing to do. How would you really describe the correlation between the startup ecosystem? I mean, we are the third largest startup ecosystem even today, but linking it to Bharat and the broader India that we have, and how do you see that really playing a role in the government's agenda of Viksit Bharat by 2047?
Yeah, I think maybe people used to say there are two Indias, right? There is the India, and then there is the Bharat. But there's actually, I think sometimes there are three Indias, right? There is the Bharat, and then there is that Bharat that lives in tier 4, tier 5 India also. See, in my opinion, there is a lot of capital, a lot of demand, a lot of exposure, because unlike maybe some of the other countries, India hasn't just grown up in certain parts of the country. India's economy has grown up in all parts of the country. I was just in Kanpur 2 weeks ago, and it's just amazing to see the kind of the kind of capital available for investment and the kind of propensity, or maybe the kind of acceptance for people there is like talking about foreign vacations. They're talking about that they will not do that when they buy things, they buy top quality stuff. So when you talk about, let's say, tier 2 cat A, right, India, Bharat rather, I think those people may have more disposable income than India cat A, because unlike us, which live in a city, 40% of our net worth is in our office and our home, right? But Bharat cat A, that's probably 10%. They have a lot more disposable income than India cat A, and they're way more open to experimenting with new things than India cat A. And I think that tells you that that ecosystem, if thought through with a focused lens, any smart entrepreneur can make $1 billion business out of just servicing Bharat. Don't even worry about India. India is very well covered by all the major guys. Bharat has a lot of money. Bharat has a lot of pent-up demand. They need a solution. They're asking for it. They are the lowest hanging fruit in India, right? In the overall scheme of what we would call India, and not addressing that for any founder, right, is probably doing a major disservice to your own company. They are willing to pay massive margins, by the way. They're willing to pay top dollar. They buy better shirts than we do. They go on better vacations than we do. They live in bigger homes than we do. They have better cars than we do. I mean, they have more Mercedes than. I mean, I went to an angel meeting. I remember about 5 years ago in Kanpur, and it was a 80 lakh rupee investment from an angel network. And when I walked in, and there was not a single car below S class, and I was like, these guys are going to put 80 lakhs into a startup. I said, each car here is with 80 lakh rupees at the moment, right? And so it tells you that they are very interested in what's happening in India. They're very much, they have massive exposure to this. They want exposure to this asset class, both from the investor side, but they're also very willing participants as consumers. You just need to know how to tap them, speak their language. There's a lot of money to be made in Bharat.
No, I mean that's. I particularly like your quote of saying that people living in cities like us, and especially both of us are sitting in Mumbai at this point in time, the amount of capital that you deploy on real estate, and just if that was available to deploy elsewhere, that's a huge multiplier. Let me also ask you a question. Investing is, people say it's a science, it's an art. I think it's a combination of both. If I were to ask you in terms of your very successful journey, what would be some of the lessons from your misses? Because I think all of us have to introspect and learn from our misses. What would be some of those lessons be, and more importantly, how has that shaped your thinking on some of the subsequent funds that you're launching in terms of risk management, governance, capital protection, preservation?
You keep learning. I think that's the best thing. Thankfully, I also come from a stockbroking family. So growing up as a 90s kid, right, and 80s and 90s kid, I think you got to hear about a lot of stories of investors who made it really big in the Harshad Mehta era or the KP era and all these other different eras that came, and just did not cash out at the right time, right, or did not do it the right way. And then collapsed because everything was built on the premise of somebody else driving up a stock price, or there was no diligence getting done, or when you were up and you should have exited, did not exit, and you just held on for too long, things like that, right? And so I had that lens even when I joined, that I need to have a very strong exit strategy. I was very clear from day one that liquidity would not be the reason why this strategy would not work. And we realized and some empirical evidence to that there are certain things very nuanced about India that one should have in your investment and exit strategy from the very get-go. That India is a very discerning market. हम Indians we only believe in the top two of any category. हमें तीसरे वाले का नाम ही याद नहीं रहता. So if somebody was to ask you, hey, if I want to book a taxi, what's the first name that come to mind? Uber and Ola, right? Despite everything, Uber and Ola. But nobody remembers the first radio taxi was probably Meru. What happened to Meru? Nobody says Meru these days. Nobody says big cabs these days. Mega cabs, big cabs, WTI, kitne sare naam aaye the. When you talk about online shopping, we talk about Flipkart and Amazon, right? I'm not talking about quick commerce, but Flipkart and Amazon. What happened to Bazi.com, Snapdeal? All these guys came before. So India, the Indian consumer is very clear. I want the top two of a category, whatever micro category you want to call it. So we have to, as a venture also, only be invested in the top two of a category. And when we invest in the company and we are not top two, sell it. If you cannot find a way to top two of a category, sell that company. While it's alive, you also get money. The first or second or third player may pay you top dollar because to combine they might become number one. But the minute you start seeing declining sales, matter is over. So I think to me that was one big lesson. And second, for me, and maybe more so over the last 5 years, Vivek, has been governance. We've realized that there is this concept that became very popular because of the West in India, this thing called founder friendly, that you should do whatever makes it easier for the founder to run the company. I don't believe in that at all. I think policies in a company should be company friendly, because a company is built by multiple stakeholders, or is a part of multiple stakeholders. Me as an investor, person as a founder, the employees, the customer, the suppliers, all of them together, make a company. And unfortunately, somewhere this founder friendly became ki whatever the founder does, the founder is God. I don't subscribe to that thought. I believe the founder, in any ways, whether you are running, the largest company in India, or whether you're running a pan wale ka store, that founder is always learning every single day. And the day the founder believes that I know everything, that is the start of the end, right? And so to me, I think the ability to decipher whether the founder will be willing to, work hard, study hard, and be teachable to his audience. That how to decipher that, or how to get to know that much faster in the journey, has been probably something that I am trying even better and better to understand. But asking nuanced questions. How do you teach yourself about your customer? How often do you want to meet your customer? How often do you talk to your team? How do you talk to your leadership? Like, how are you going to deal with conflicts in the organization? Is it your word and then everybody else's word? I think these kind of things to me have become more and more relevant because the amount of money coming into India has become much larger, and these founder-centric companies, and you, without even naming them, but you know who I'm talking about, these founder-centric companies have not done well, right, as a entire asset class. But those companies that had a framework, and there are brilliant companies that we can talk about where there was a leadership, there's a founders, then there is a leadership, and then there is a second level of leadership, and then there is a framework of how to run a company. Look at how many billions of dollars they've made for us, both in India and abroad.
Very true. Very true. Again, I think company first or broader stakeholder first, as opposed to founder friendly, is the mantra.
Yeah.
To that. Anirudh, if I may, if you look at your family's interests, I would say, when I say interest in terms of into investments and ventures, it spans across different sectors. It's renewables, it's real estate, hospitality, and beyond. If I may ask, what is the integration that happens from, if I can use the word non-core, outside of the active sectors that you get into, to inform some of the decisions back into capital allocation for the family?
So the family was very clear when I started Artha that the initial capital that they had given, that the capital was not expected back to go fund any of the operating businesses. The reason to set up a specific company was that every time we invested, then you were like, okay, which company should I invest from, or which kiski books mein se invest karna hai, type of thing. And we realized this was not sustainable. If you wanted to create a proper venture, and you wanted to have a team that should realize that they own the portfolio, and that they whatever we make on the portfolio, they are a carry owner of that. You need to have it in a way where they can also measure the portfolio better. When you have it distributed across so many different names, it's going to be very difficult. So our thought process was very clear from day one ki whatever capital injected here once, there was no dividends going to be paid back. That was very clear. The intent was, how can we grow this into a massive thing, and whether we list it later on or what we're going to do with it, that would evolve over a period of time. So that was a very clear thought process on the day we started, right? So there was no expectation from family ki, oh, you know what, one day you're going to give me these dividends and this money back. Like, grow this thing, let's see where you take it. Maybe it just becomes something that is self-sustaining, which is where our renewable ventures can fund the equity ventures, and the equity ventures can go back and keep funding more renewable stuff. And that, I think, has done really well as a cycle. So, but yeah, I think over a period of time, what I've seen, and many other family offices have wanted to join us with the intent of saying, can we also recreate this for our family offices? And we're working with a bunch of them of setting up these operating plus investment structures for them, and hopefully in a couple of years we might look at listing this whole thing and making it like a permanent capital vehicle in India.
Very, very insightful, and you really had the benefit of seeing both founders and investors over a period of time. We started the journey in 2012 to we are now in 2026. The whole ecosystem has matured. What would be your advice to investors or the next generation of the families who are now starting to invest in early stage startups?
There's just so much, but maybe I'll try to distill that in maybe 2-3 points. I think it's very important to first allocate how much of your portfolio are you going to put into venture. See, venture it's so exciting. Truly, honestly, if I had my own mint, right, where I could just mint money, I would be writing checks every day. But I don't, right? And I think that scarcity also is important, because otherwise you'll keep funding things. But my point was that you need to decide, okay, let's say my entire portfolio is 100, of which let's say 50 rupees is probably fixed income. Out of the 50 I've allocated for equity, maybe 20% of an overall portfolio should be in venture. But venture itself is also split into 2-3 parts. You have early stage, you have growth, you have private equity, you have pre-IPO, and maybe venture debt sort of also forms a part of this portfolio, right? I don't think it's a true debt portfolio. It's more of a venture portfolio kind of a thing. So you have to decide how much allocation am I going to put everywhere, right? And understand that this is a 10-year journey, bare minimum. And in my opinion, it's actually a 25-year journey, because you can't just invest in one fund. You have to have a 3-fund allocation. That maybe if fund 1 I put, let's say 10 rupees into fund 1, I'm going to put 20 rupees into fund 2 and 40 rupees into fund 3. because I'm growing with the manager and I have a very good understanding of that manager. What's really, really important along with that is what am I learning from the manager? Some of the best LPs that we have and who have been with me since Fund 1 and now my overall 6th fund, but are those that have come to my office every 15 days and we have one cup of coffee and we discuss the portfolio. And their allocation to me was very clear that, Anirudh, what am I putting in the fund is irrelevant to me. But what I need from you is one coffee a month or one coffee every 15 days. And the amount of knowledge I have gained from them is multiples of what probably they have learned from Artha and our journey. But they are very disciplined in stating that I'm not here to do direct investing. I'm here to invest via you, but I'm going to learn through 3 or 4 cycles of how these portfolios get created. And now some of them are co-making funds with us. They've discovered, okay, in this space I can create a decent portfolio. Let's do this fund together, right? Now, I think that's a very smart way of going it because you have learned without having to put together a team and without having to put together a structure and try to win deal flow everywhere. You have sort of co-helped a fund. You've seen your own money grow while you've also learned. I think for the next gen, that's really, really important. It's, and India, we have these cycles every 5 years or 6 years. You'll notice, the market goes up, market goes down. You have to go through at least 3 cycles to truly understand what's the best time to be investing and what's the best time to be exiting. And writing a venture check, getting into a venture deal is the easiest thing. Please ask any venture investor, writing a check is the easiest thing. Getting that check back, real work starts there. Now, between the time you gave the check and the time you got the money back, the amount of time, effort, blood, sweat, tears, late night sessions, the renegotiations on SHA, the company dying 1,000 deaths, the founder dying 1,000,000 deaths probably, right? Because they're just all of those things you have to be there for. You can't quantify that, but if you can't provide that time, then don't do a direct check. Because you're doing truly a disservice to the founder if you're not able to provide them, when I say founder, the company and the founder, by not being able to provide them something beyond the money, right? Especially in a market like India where we have a fairly complex, although ease of doing business we've done better, but it's a fairly complex ecosystem to operate in, and the founders need advice. In no school of India, I know, where they teach you कि every month 7th को TDS भरना होता है, 20th को GST भरते हैं. GST का बिल, GST की reconciliation कैसे होती है? Any school in India teaching that? Only the CAs know it. The founders, most of them, unfortunately, don't know it. They don't even know that you have to fill advance tax 4 times a year, right? Who knows that? But my point is, because they don't, and you're coming in as a direct investor, the onus falls on us as people who understand the ecosystem, as people who are business people who understand and have these frameworks there to teach the founder what they could do better. And if you can't do that, then let a venture manager do it. Because you're doing a disservice. Yes, you might lead the round. Yes, you might have 2 crore rupees lying around. You might have 4 crores to write a check. You led the round. You got your name in the papers. But after that, you didn't have time for the founder. The founder is unfortunately making tons and tons of mistakes because where we could have mentored and guided him, you weren't around. So don't do that. Go through a venture manager. They'll have a team. They will have a framework to support post investment, and let them do it. I think that's 2 pieces of probably where I see most family offices have gone or have now realized where they've gone wrong. It was very easy. I know family offices wrote 80 seat checks in a year. 80. I've written 150 in 14 years. They did 80 in a year. That means they were writing a check once. They were writing a check every 4 days. Now, I don't know how, right? But they were. And to me, I think you're going to get a suboptimal portfolio if you're going to write at that frequency. You have to have a very thick skin, and you need to say no to 99.5% of the ventures. And for sometimes for family offices that becomes difficult because it comes from a good reference. फिर आपका वो personal relationship थोड़ा सा ऊपर नीचे हो सकता है. Let a venture manager say no. You also have 1 degree of separation now. The venture manager said no. I think those are the kind of things that family offices need, or with a focused venture strategy, should think through before they get involved in this asset class.
Yeah, that was very, very well articulated. And it's a perfect segue to the next question that I want to ask you. Building a legacy, an intergenerational legacy, goes beyond just availability of finance and capital. It requires vision, it requires values, it requires governance. If you were to articulate how are you institutionalizing this for an intergenerational period at Artha, what would be your views?
What we're doing at Artha, though, I will we are looking at writing down everything that we've done so far, and we're building our own database. We've had a database. We were using third-party cloud software to sort of save everything, but now we're creating something in-house so that we have sort of our own small language model. So the next person when they join, they can get a wealth of experience because 15 years, probably at least a couple of million emails have gone back and forth from Artha. There's just so much knowledge and value there that they could both. We probably so many rejection emails have gone out, and we've been wrong. And we've said no to stuff. We've said yes to stuff and been wrong. And that's all that wealth of knowledge sits there. And we've just hired a tech team to start building out this database for us. But that probably is the easier part to learn from. I, however, and I'm writing this down. I haven't, I'm articulating it as I go, but and I probably write it, probably have it down at some point in our office, which is, what do we really stand for? Right? When we're investing, what should we be thinking about? And I want to define them by P's, right? I think first the first P is plan. Did we invest by a plan? Or did we write something that was very fancy on a PPM and that did not follow that at all for the next 7 years? Right? I think if we did that, then we have done a disservice because then that plan was written just to convince others that we have a plan. So we should invest via a plan. Yes, you can make adjustments to the plan, but you can't abandon the plan completely. So did we have a plan? Because then every plan will give us a learning. That the next time when I write the plan for the next one, there was a plan here, there was a learning here. Now I'm writing the next plan. Right. Second is protection of capital. My dad always said that returns are fun, can be looked at later, but are you going to get your capital back, right? And in venture, I think that's very, very important. How strong is your underwriting to ensure that you get your 1x back first? Because once you're 1x back, then returns is next. But not even getting 1x back to me is destruction of capital, which I think is Warren Buffett's 2 rules, right? A, don't lose money, and B, don't forget rule 1. I think to me, protection of capital very, very important. How strongly are we underwriting stuff? Third is performance. When I'm investing in venture, I cannot just incrementally beat Nifty. A market like India, Nifty performs at 12 to 16% IRR, depending upon the term you take. Most small cap funds in India are at 24% plus. They're very easy to buy. They're very easy to sell. I can get into a DSP small cap fund tomorrow morning. I can get out, 2 years from now. Usually not a big problem. I am asking you to lock in your capital with me for about a 5-year hold period, right? Looking at the drawdown periods and stuff. Which means if I'm not beating DSP's small cap fund by at least 2.5, 3x, I don't deserve to earn the capital that they have that would otherwise go to them. It's all opportunity cost. But to me, performance has to be at least 2.5 to 3 times what a comparable, ETF or a comparable index, and we normally benchmark ourselves against Nifty 500. But if Nifty 500 give 14% in a period of time, I should be at 42% or higher. If I don't, then I'm not doing a service to that capital because that capital demanded a higher opportunity cost of me because I'm in venture. So performance is that. And last thing is pride. Am I proud to talk about the investments I've made? At the dinner table, when I go to events, when I meet with other families, both India and globally, am I proud to talk about, hey, I was a first investor in Agnikul, or I was a first investor in Purple, or I was, we backed this thing called Take Me to Space, or we have a company like Lendin Club, which is doing 100 crore plus profit this year, and they are this massive thing that we've created, where we were not created, but where we were a participant from the very start. To me, those 4 P's, if I can inculcate that into the generation of people that are now joining Artha, and they can carry it forward, I think we would have done our job. Because all other things will be fungible. India, there was no AI 10 years ago. There was 10 years later, maybe there'll be something that we not thought about now. So we can't have defined rules for that. But if we just say, listen, evaluate these 4 Ps, or maybe they become 5 Ps eventually. But evaluate on that, right? And if you think that we are meeting those, let's do it. I think I'll be more than happy if that is what I can inculcate in the next generation as they come in. And most importantly, pride. Are you proud of what you're doing? Because if you're not proud of what you're doing, then you're definitely doing something that you should not be doing.
No, that's a great way. That's a great way. You talk about principles and you sum it up as 4 Ps. And clearly to me as well, the last P, which is pride, resonates the most. Anirudh, it's been a pleasure to have you here. Thank you so much. I'm sure everyone has gained a lot from your insights and your experiences, and look forward to seeing you further.
Thank you so much, Vivek. Thank you so much for having me here, and looking forward to having one more interaction like this in the future. Thanks.
Pleasure will be all ours.
Thanks. Thank you.